Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to your Tax-Free Life podcast. As always, I'm excited to be here with you each and every week, bringing you lots of information and education so you can make better financial decisions, not only for yourself, but also for your family now and obviously in retirement. Now, today we're going to be covering the understanding your financial paradigms in retirement. And this is going to be part 5 of a 7-part series, which we have been doing, and we've been receiving a lot of really good feedback from many of you that are actually getting to learn and understand things that no one had ever talked to you about as you prepare for retirement. You know, one of the biggest challenges that we find when we do retirement audits for our clients is that many of the issues, the concerns, the things that retirement brings to the forefront, the vast majority of Americans and the vast majority of clients that we engage for the first time have never been advised or have never been educated on those critical issues. So our number one goal obviously is to bring education to you, because at the end of the day, although there is more information in the marketplace than ever before, Americans are worse off than they've ever been. And the reason for that is that information without education always leads to failure. So part 5 today is going to be dealing with, you know, how do you protect yourself? How do you protect your family? And how do you protect your retirement assets from stock market volatility and market losses? Obviously, as we all know, the impact of losses on a retirement portfolio are tremendous. Now, obviously, the paradigm shift that most of us have to take is that while we are putting money away for retirement, you know, we have always taken the position that the stock market will always do fine. And yes, there are going to be ups and there are going to be downs, but over the long term, the market is going to do fine. The challenge with that is that the markets are unpredictable and volatile, and when you move from accumulation to distribution, in other words, when you retire and instead of you working for your money, now your money has to work for you, then stock market volatility and the unpredictability of the market can definitely create havoc to your retirement portfolio, to the point that you may actually, unless you protect yourself against it, you may very well run out of money before you run out of life, just based on longevity planning or longevity living and stock market volatility and taxation. For those of you that may not remember, many investors lost between 30 and 50% of their investments, especially their retirement investments, during 2008. And that was only 11 years ago. But, you know, we as humans, we have a tendency to put bad things in the back of our minds, and we have a tendency also to forget about them. And if you don't remember the past, you're more than likely bound to repeat it at some point in time in the future. Also, for many years, you have heard of the buy and hold strategies in retirement, and the fact that if you buy and hold, no matter what happens to the market, as long as you have time on your side of the ledger, then chances are you're going to be doing well, and you will do well for yourself and your family. Well, the question there is, and does it really work during retirement? See, when you reach retirement, you no longer can afford to just buy and hold, because every single year you're going to have to dip into your retirement accounts in order to maintain your standard of living. So you no longer have time on your side of the ledger in order to try to offset those years in which the market may not do well. then obviously the next question is, well, is asset allocation enough? And again, the old paradigm would say the proper asset allocation will do the trick, regardless of market conditions at any given point. Obviously, in the next few minutes, you're going to find something totally different when it comes to that statement. And the bottom line is that a down market at the wrong time may actually force you and your family to postpone retirement indefinitely. And that's something that you really need to protect yourself and your family against if you want to minimize those volatilities at some point in time in the future. Now, I think before we start really thinking about how to protect ourselves and our retirement assets and our retirement accounts from stock market volatility and or any other type of volatility available in the marketplace, I think it would be important to understand the two types of investment risks that each and every one of us may be facing at some point in time in the future. The first one is what we call an unsystematic risk. Unsystematic risk. And this is the risk associated with investing in a single company. Now, what could happen when you have all your eggs in one basket, or when you put all of your money in a single company? Well, a number of things can happen. You can have employee go on strikes, product failures, and we've seen many of those over the years. The CEO dies or gets fired. Business scandals, corporate scandals, fraud. I mean, think of all the major companies that went under not too long ago. Enron comes to mind as one of them, where all of a sudden, the vast majority of employees were multimillionaires, and just overnight, they were totally ruined because of the fraud assigned to that particular company. I'll give you an example of an unsystematic risk. If you had, let's say back in 2007, if you had all of your money invested in Citigroup stock C, that stock went from $54.38 in 2007 to almost zero in 2008. And that was because, obviously, like many other companies at that point in time, they invested a tremendous amount of money in credit, in CDSs, which are credit default swaps and derivatives. Now, you would say, well, Bert, why would anyone want to have all of their money invested in Citigroup stock C? Well, a lot of people had, perhaps not 100%, but they had 60, 70, 80% of their money in that particular stock. So you would think that obviously you're not going to have all your eggs in one basket. So then you're going to start to diversify. And then when you diversify, you're now going from an unsystematic risk, which was the risk of investing in a single company, to something that we in the business call a systematic risk. And a systematic risk would obviously be the solution to unsystematic risk because of the fact that we now would not be investing all our eggs in one basket. We would not be investing all of our retirement money in one single company. So now we would be investing in a broad range of companies and asset allocation models that would include, and I'm just giving you a few, cash, U.S. stocks, non-U.S. stocks, international bonds, domestic bonds, etc. So by investing in a broad range of companies and also by investing in a broad range of asset allocations, you would at least minimize the risk of unsystematic risk, which is putting all your eggs in one basket. Now, just because you do that, and now you have proper asset allocation under a systematic risk approach, it does not mean, as you will see in the next few minutes, that you will not lose some of your money, or perhaps even the vast majority of your retirement assets at the wrong time. Obviously, it's a systematic risk. It's the risk inherent to the entire market. So, for instance, 9/11, it didn't matter where you had your money. When 9/11 took place, the entire market dropped dramatically. What happens when there's major inflation, higher taxes, credit crisis, recessions, depressions? How about military wars? How about trade wars, as the ones that we're seeing today? When all of these things happen, then obviously systematic risk may not be enough, because at the end of the day, no amount of asset allocation and or diversification can actually protect you, your family, and your assets from systematic risk. As a matter of fact, if you look at systematic risk between 2004 and 2009, and let's say that you would have invested 25% of your money in the Russell 2000, 25% in the Dow Jones Industrial Average, let's say 25% in NASDAQ, and then finally the last 25% in the S&P 500. Now, from an asset allocation standpoint and from a diversification perspective, you would feel that you are totally protected, because you would have invested in different sectors, and you would have invested in over 2,600 companies along those lines. But then again, when 2008 hit, the vast majority of Americans lost anywhere between 30 and 50% of their investments. Can you imagine if you had just entered retirement at that point in time? Can you imagine if you had entered retirement in 2007? And now all of a sudden you need to start taking distributions out of your retirement assets in order to maintain your standard of living. And then 2008 hits, and now your portfolio suffered 30, 40, 50% in losses in 1 year. And on top of that, you needed to continue to take money out of a depleting portfolio because of the fact that you needed to maintain your standard of living. How do you think your portfolio would have done? Do you think that your portfolio would have been able to recover from those losses? I would argue that if you had retired in 2008, more than likely you would still not be recovered even through 2019 out of those losses that you suffered at that given time. So now the question is, well, what are then the solutions to a systematic and a unsystematic risk? So if you don't want to have all your eggs in one basket, and even if you diversify and you put all your eggs in different baskets in different sectors of the market, and there's still a susceptibility to market losses, then what can we do? What can you do? What can Americans do in order to protect themselves from a systematic or an unsystematic risk? Well, you can definitely start something that we call a principal protection program. And the principal protection program is a program that allows you to unload the systematic and unsystematic risk to a large financial institution. Now, this is where fixed index annuities come into play, because fixed index annuities will allow you to link your account growth, in other words, the growth of your portfolio, your retirement portfolio, to the upward movement of the stock market, while by the same token safeguarding your principal against any type of market losses. So you get to have your cake and eat it too. You actually have the ability to invest in a fixed index annuity, and we don't have the time today to go into the many different fixed index annuities that are available in the marketplace, but I think it's important for me to let you know what's available in the marketplace. And the fact that a fixed index annuity gives you the ability to invest and benefit from the uptick of the stock market, but not having your money at risk when you are in a market loss portfolio in a given year. So your principal will always be protected. For those of you that may have visited Vegas at some point in time in your lives, let's say that you're sitting at the black table. You know, when you play blackjack at Vegas or any place where you want to gamble and play blackjack, you have the ability to win, you have the ability to lose, and also you have the ability to push, which is when you tie the dealer, and then obviously you don't lose, but you don't gain. Well, can you imagine if you showed up to Vegas on a given night and you sat at a blackjack table and all of a sudden the dealer says, well, guys, I'm going to be changing the rules of engagement for this table indefinitely. And as you all know, you have the ability to either win, lose, or push, but moving forward at this table, you're only going to have the ability to win and to push. The big question I would like to ask each and every one of you is, how long would you be sitting at that table? In my case, I'm going to be sitting at that table for the rest of my life. Because if the only thing that I can do is win or tie and never lose, I'm going to sit at that table. I'm going to eat lunch. I'm going to take showers. I'm going to take baby baths at that table. I'm not going to leave that table for the next several years because at the end of the day, there is no probability of loss that can ever be assigned to that blackjack table or to my retirement accounts because of the fixed index annuity products and features that are available to the vast majority of Americans. Now, before you start going crazy and try to figure out which fixed index annuity may be suitable for you, there are many of them, and they come in different flavors. So it's just like when you go to Baskin Robbins for ice cream, there are 31 different flavors. So you have to make certain that you talk to your advisor and make certain that you're going to purchase the right amount, and then also how much of your portfolio should go into a fixed index annuity. The rule of thumb basically says that you would take your age from the number 100, and then that would be the amount that you would put into a fixed index annuity so you can protect yourself and your family from stock market volatility. So if you're 60 years of age, I would argue that 60% of your portfolio should be in a fixed index annuity. If you're 70 years of age, then obviously 70% should be in a fixed index annuity or in a principal protection guaranteed program. And also think of it this way. You need to have, all of us, and this is something that many of us don't think through when we are in retirement or approaching retirement, we don't think about portfolio protection. See, we cannot protect everything else in our lives. Many of us, we protect our life through life insurance, to protect us from the risk of premature death. We purchase automobile insurance to protect ourselves and our families from an automobile accident. We purchase homeowners insurance. We actually even protect our income through disability income insurance contracts. So why not protect your hard-earned dollars, your retirement assets, by putting a portion of your assets in a principal protection program? Now, obviously, there are many features and benefits that I have talked about in the past regarding the different principal protection programs. And then once we are done with the 7-part series of understanding your financial paradigms, I will dedicate one podcast to fixed index annuities and how they can, in many different ways, improve and facilitate your retirement life. Now, also, from a risk perspective, you have to think of it this way as well. If your retirement portfolio is down 40% in a given year, you need a 67% return in 1 year in order to break even. Now, when was the last time that the stock market went up by 67% in a given year? I don't think I've ever seen that, and more than likely I'm not going to see it in my lifetime. But let's say that you drop 40% in a given year, and this is without taking any money out of the portfolio, by the way. If you drop 40%, as many people did in 2008, and let's say that the market were to recover at an 8% clip over the next several years, which is a fairly good rate of return as a recovery percentage, then it would take you 6.6 years to recover from that 40% loss in the first year. So if you have a 40% loss in year one, and the market is recovering at an 8% gain every single year thereafter, it would still take you 6.6 years to recover from that 40% loss. So the bottom line is that you want to do what Warren Buffett says. He's got two principles of investments. Number one, never lose the principal amount of your investment. And number two, do not forget rule number one. So with that being said, I think it is important and apropos to all of you to make certain that you understand risk from a different perspective when it comes to managing your retirement portfolio and your assets. In this same exercise that I just walked you through, if you were in retirement when that 40% loss occurred in 2008, and you still needed to dip into that portfolio and take money out in that given year and the following years in order to mitigate your standard of living, you would have never been able to recover from such a drop. So again, I think all of us need to pay attention, all of you need to pay attention to what's truly important when it comes to a systematic risk, unsystematic risk, and how to create the avenues and the opportunities so you can go to Vegas with your financial money, with your financial and retirement assets, and be able to sit at that blackjack table knowing that you can only win or push, because there's no risk averse and or probability that you will lose any of your retirement principal from any type of market losses in the future. So obviously this is pretty much the end of part 5 of our podcast, our 7 series podcast. As always, it would be great if you can subscribe to our channel so you can get it every single week. For those of you that may have any questions regarding what I've talked about today, or if you want to discuss anything regarding fixed index annuities, please feel free to reach out to me. You can call me at area code 786-766-1042, or you can send me an email at Bert, B-E-R-T, at gablestaxgroup.com, and I'll be more than happy to schedule a 30-minute video conference and or conference call with you at no cost or obligation, and hopefully help you and your family in mitigating the risk of our retirement risk at some point in time in the future. So as I always say to all of you at the end of every single podcast or webinar or webcast or seminar, my number one goal and that of my company is to help each and every one of you and your families kind of change in the way that you see things, because when you change the way that you see things, the things that you see change. So again, thank you so much for giving me a few minutes of your time today, and I'm looking forward to talking to you next week. So have a great week and talk to you soon. Take care. Bye-bye.